Hedge fund giant Jim Simons has agreed to pay the biggest sum of money for taxes and penalties in the history of the United States. The total figure is reported to be $7 billion, coming from 10 years of trading activity from his hedge fund. Just think about a $7 billion penalty for a minute. There are only about 50 people on the earth who have a net worth above $7 or $10 billion. And Simons has to pay that amount as a part of this agreement with the IRS. We are going to get into the activities that led to this historic fine, the details on why Simons and his hedge fund have to pay it, some of the changes to the laws on how hedge funds can trade that'll come from this, and a little bit of the behind the scenes on what may have potentially actually motivated Congress and the IRS to pursue this huge sum of money. Jim Simons ran one of the biggest hedge funds in history, and Forbes currently ranks him as the single wealthiest hedge fund manager in the world. They estimate his current net worth to be somewhere around $25 billion. At least until he pays this tax bill, that is. Simons started his company Renaissance Technologies in 1978, and it was really one of the first quantitative or technical trading based hedge funds out there. He and his hedge fund became wildly popular in 2019 after the release of the novel that covered it called The Man Who Solved the Markets, which, by the way, is one of the most interesting books I think I've ever read. And so for all of you who ask me for book recommendations, that would be near the top of the list. Now, all the details and all the specific reasons for these tax penalties coming about are not exactly clear because they stem from very complicated financial derivative products. But in general, the dispute involved Renaissance Technologies' flagship hedge fund called the Medallion Fund and its fast-paced options trading strategies and how those strategies were being taxed. The taxation on these strategies was always a major consideration for the hedge fund, given that the firm's rapid-fire trading techniques had always generated huge profits for its owners and investors. At the time of the transactions that the IRS is questioning, the federal tax rate on long-term capital gains was about half the rate of what it was for short-term capital gains. The hedge fund and its accountants had long argued that many of its trades qualified for long-term capital gains treatment because it almost always converted its options trading strategies into long-term holding through the use of complex financial instruments. The bread and butter of the Medallion Fund's trading strategies were built around these baskets of stock options put together by some investment banks like Deutsche Bank or Barclays, made specifically for that fund's uses. The fund was able to shelter about $34 billion of profits throughout this 10-year period into those options baskets that they argued should be treated as long-term gains. This cut the tax rate that the fund was paying on those profits by about 20% throughout that decade. That 20% tax savings on about $34 billion of profits gets us to the $7 billion that the IRS is coming after. The reason that Simons and his accountants had long argued that these trades should be treated as long-term gains was because the Medallion Fund didn't actually buy the baskets of stocks that these hedge funds were creating. Instead, it was buying options based on the value of the price of those baskets of stocks, and then it was giving the investment banks instructions on how to buy and sell the stocks within those baskets. You may be able to see now why the inner workings on how the taxation of these things works was not totally clear. These basketed options have long been criticized because they allow investment banks to offer products to hedge funds which allow them to leverage their money more so that they can take bigger but also potentially more risky trades. And that exact reason is why Simon and his team had argued that these should be getting long-term capital gains tax treatment because they weren't doing these things just to avoid the taxes, they were rather doing them to leverage up. The IRS argued that trading in these baskets of options should be taxed at the higher short-term capital gains rate because the profits associated with them was the result of short-term trading by the banks. If you ask me, it does seem a little bit shady for hedge funds to be able to take advantage of this type of financial product and then potentially get a preferential tax treatment on their trading. But once you hear about what the IRS is doing because of this, you might start to feel like that party is being even more unethical. This disagreement has drawn attention from Congress and is now leading to some rule changes. Following a report from the Senate Committee on Investigations, the IRS sought to clamp down on this type of trading by hedge funds by making it more costly to trade these basketed options. Such activity would now have to be declared on the tax return of any investors who used them, meaning every single person who is invested in the Medallion Fund that Simons was managing. The IRS has said that its guidance on these basket options should be retroactive for all trading activity dated back to 2011. That's right, they want to change how all trades with these vehicles were taxed for the past 10 years. To me, it feels like criminal and illegal for a tax agency to say, hey, we're going to change the rule on how something gets treated in our eyes, and anyone who was doing it the old way for the prior 10 years is going to have to pay us extra taxes. It feels like they're just stealing money. If this is okay for the Senate and the IRS to do, what stops them from, in the future, when they potentially decide to increase income tax rates, also choose to backdate when that increase occurred and charge every single family in America $10,000 or $50,000 in income taxes? I don't like how it sounds, and it could be a slippery slope. And in case you haven't heard, this exact backdating of tax rules may be being applied to the new infrastructure bill being pushed through Congress and Senate by Democrats right now. One of the laws within this $3.5 trillion bill says that they're going to increase the long-term capital gains tax rates for those people earning more than $500,000 per year. And even though this bill may not pass until later in 2021 or in early 2022, there is some language in the bill that says the increase in long-term capital gains tax rates may be dated back to September 13th, 2021, which is the next market trading day as of the recording of this video. And again, that just sounds absolutely crazy to me. Not necessarily that they're increasing tax rates, but that they would pass a law, let's say it's in February of 2022, and say, yeah, this is what taxes are going to look like moving forward, but also everything from September of last year until now is also going to be taxed at these rates. You know, as a financial advisor, people plan their investment strategies around taxes a lot of times. Maybe I'm biased, but it just feels really dirty to backdate tax rules and charge people money for things that happened before a law was even passed. So who's being more shady here? Jim Simons and his hedge fund, or the IRS? Who knows? That's for you to decide. Now, there is a conversation that could be had about why the IRS even decided to pursue this $7 billion fines from Jim Simons and his hedge fund. Sure, you could argue like moral justice, or I guess in this case, tax justice, but really at the end of the day, $7 billion is not going to make much of a difference to the US budget at all. So why did the IRS spend years fighting out this case with Simons and his team to get this $7 billion? Sometimes in high-profile cases like this, there are sort of personal vendettas that may be at play between the leaders of major institutions. So I'm not saying that this is the exact reason why the IRS chose to pursue this penalty, but there is a lot of talk in the media around Robert Mercer, or Bob Mercer, one of the other owners of the Medallion Fund, and how he funneled tens or 50 or hundreds of millions of dollars to the Trump campaign and to other Republicans in 2016. Now that Democrats are back in control of the Senate and White House here in the United States, people are saying that they are motivating the IRS, or maybe leaders within the IRS are choosing to pursue this fund because they just don't like Mercer because of his past political affiliations and some potential other issues they may have had with him. Personally, I feel like that motivation is relatively likely. Maybe it's like a 50-50 chance that the IRS is partly being motivated by some personal vendettas against Mercer and choosing to pursue this historically large fine against Simons and his hedge fund as more of a PR statement to say, hey look, these were bad guys. Again, $7 billion is just not going to save our budget deficit here in the United States, but it could tarnish the reputation of someone that maybe the leaders of other organizations don't like so much. But that's just one theory. Take it for what it's worth. In other news, there's an even bigger lawsuit that's being put in action against YouTube right now. I myself and this YouTube channel Straight Talks are suing Google to the tune of $1 trillion. It's been said by some of the most intelligent and educated YouTubers out there on the planet that the content being posted to this very YouTube channel is well above the entertainment value and quality of anything else out there in the world, even from the likes of Mr. Beast or PewDiePie or the other most popular YouTubers. However, it is very clear that YouTube is throttling the subscribers to this channel since it's not already at 1 million. So I expect to win this $1 trillion lawsuit against Google in very short order, and then I plan to donate this $1 trillion in equal portions to everyone who is subscribed to this channel. So tell your friends. Thanks for watching.